Hey everybody, this is BeatTheBush. Today we're going to talk about investments, which happens to be your favorite topic on this YouTube channel. Today we're going to talk about a thing that they always teach you in finance markets, which states that the law of efficient markets is efficient, which means the asset price or the stock price will always reflect all the information that is known. This means you cannot beat the market no matter what you do, because if you go in with the knowledge that everyone else has, you're not going to be able to predict that the asset price is going to go up. Now this is on an average basis, so you might be able to still buy an asset somewhere and then get lucky and then it'll go up. The thing it states is that you cannot do this on a consistent basis over a long period of time. This theory of efficient markets was developed by a professor named Eugene Fama. In 2012, they did a study on all the mutual funds. Mutual funds are these assets, classes of assets that's bunched together, professionally managed by people who went to school, who are supposedly very smart, in that they should be smart enough to be able to pick things and get performance over the standard. They found out that these professional managers essentially cannot outperform a set of assets where it was actually randomly picked. But the point here is that they actually average the performance of all the mutual fund managers. They didn't pick out some of them who were able to consistently beat the market. They averaged them, yes. If you average all the performance of everybody, of course you're gonna get average results. That's my theory here in saying that the market is really not efficient. Take a thought experiment, for example. Let's say a company is doing an announcement and they release it to everybody at once, but some people are going to, in fact, get that information first. Maybe if they are really on the ball, they sit right next to the computer and they see this news saying that, oh, they made, let's say, 100% more profit that quarter. Suddenly the asset price jumps a lot. Just looking at the asset price, it's going to jump, but then you know that the time it takes for that information to percolate to every single person is going to take time. So eventually it's going to kind of trickle upwards a little bit more and more. That right there shows that it's not completely efficient. Because if it were, once the piece of news released, it would just kind of jump in a very straight edge manner and stay there. In most cases, there's no extra information that's released, and yet the asset price would keep on going. It's not just me that is saying this. I mean, if you look at a lot of the Warren Buffett type of newsletter, their shareholder newsletter, they also believe that the market is not efficient. Otherwise, you cannot take advantage of it and in order to profit from it. Now, if you plan to be an average trader, you're going to get an average performance. And if you think that you're never going to be able to outperform the market, well, why even try, right? So you should really just buy an index fund. In fact, an index fund, let's say the S&P 500, in the whole history, you get on average about 6 to 7%. So the argument for the efficient market is that why even try? Why even bother? Because you're gonna have some chance of outperforming the market, but also an equal chance of underperforming the market. So why chance it and just buy an index fund and just receive the 6 to 7% of compounded annual growth, which is over the whole length of, like many years of the S&P 500. That's the performance history. So if you want 6 or 7%, you can essentially just buy an S&P 500 and just keep on buying it year after year, or every single month you put a little bit more in. You're pretty much guaranteed 6 or 7% over the long term. Over the short term, it might go down a bit, but then if you just kind of wait it out and just keep on buying, you will get your 6 or 7%. The point here is that I believe you can outperform the market. I obviously don't have enough history to say that I can outperform the market, but look at all these managers that are trying. What keeps you from trying to outperform the market? Of course, you never know if you're the next Warren Buffett or not unless you try, right? So the conclusion is this: I believe the law of efficient market does not hold, is actually inefficient. There are times of overpricing of the asset and there are times of underpricing the asset. If you're brave enough, which is something you actually shouldn't do, is if you think the asset price is overpriced, way overpriced, you may want to short the market. But there's a popular saying that the asset price that's overpriced can keep staying overpriced longer than you can stay solvent in shorting the stock. Because if you short the stock and it keeps on going up, you're gonna lose money on it. And then they would do like a margin call and you have to keep on paying. And it's saying that you're gonna have to keep on paying until you have no money left and you have no margin of error, and it'll essentially go up so high that you'll lose everything you have. So shorting is a very dangerous business. That's on your own to decide if you want to do that or not. On the flip side, you can take advantage of the low side of a stock where people are actually undervaluing it. Now, if you partake in buying any kind of assets of individual companies, then you are essentially saying that the market is inefficient because you think that if you buy into it, it'll essentially increase in price to the point where you think you can make more than the average fund manager, which is better than randomly picking a stock. So in order to pull off any crazy Warren Buffett type of investment where you make consistent gains, you actually have to believe that the market is inefficient, so that'll allow you to take advantage of the low prices that comes around and you can buy. It makes sense to me that an asset price will be priced low. There is a lot of market psychology involved. In one of my previous videos, I showed that there's market cycles where people like go kind of crazy when asset prices go up, there's a bubble and then it goes down. And when people run for their lives, that's actually when you should buy. So the conclusion of this is that the markets are actually inefficient and you should really only try to buy into the stock market if you think you can outperform a randomly picked fund manager, which is actually very hard to do. So my wish is for you to listen to this and take this as opinion and kind of process it yourself and make up your own decisions about whether the market is efficient or inefficient. So I'm interested if you think the market is efficient or inefficient after this video. Leave a comment down below to let me know. Give me a like over here and don't forget to subscribe. Thanks for watching. I actually have a pile of gold coins over here. I figured this is related to investing, but these are actually chocolate coins and you can eat them. Typically when you buy these from the supermarket, they kind of taste like plastic. But not these. These, I got them at Costco, and this has a rich flavor to it. They're milk chocolate. Yeah, I don't have a link for you to buy them or anything, but they're pretty good.